my introduction video, you would have heard me use the term stocks and bonds quite often. So I'm going to just explain what those are right now. So you'll hear the term stocks and shares sometimes interchangeably, but when you hear stocks, it's a broad term referring to investing in stock markets in general. When you hear shares, you're speaking to about a specific company most of the time. So shares in Apple or shares in Google. Basically, a share is ownership, is a stake, it's a piece. Consider a pizza cut in 8 slices and you get your share. When you get your share, you own an eighth. So when you purchase stocks or you purchase shares in an individual company, you're actually part owner of that company. And how that company performs then determines the value of the shares that you hold. What happens with, imagine you own Apple shares, you own 10 Apple shares and they're valued at $100 each. That's $1,000 that you have in Apple shares. If Apple has a new iPhone that's coming out and it's expected to do well, there's demand for the shares that you have. People want those shares. People are willing to pay you $150 for your shares. So now your shares are worth $1,500. So the value of your shares have gone up by $500 or 50%. So that's how stocks work. You're an owner and the value of your ownership has gone up when the overall value of the company has gone up. However, if that phone was to flop and people thought that Apple shares were going south, then they would try to sell and they may be willing to sell for $75 to get rid of the shares because they think it's going to get worse. So now your value has gone down by 25% and the value of your shares in Apple are only $750. You have a loss, an unrealized loss of $250. So stocks are a bit more risky, but the reward is also greater. So we always talk about risk and reward in investing. So you take a greater risk for a greater reward. There is no reason to take greater risk for a little reward. And stocks tend to have a greater trade-off between risk and reward. And we'll find that people who are more risk averse may stay away from stocks and shares in companies. But it would be my advice that you still put a portion of your funds in stocks if you can, because the upside is great. And if it's a small portion, then the downside will be limited. Bonds is a more familiar term for those of us in the Caribbean. Bonds are, you hear about government bonds, and bonds are you lending to an organization. So when you purchase a bond, a government bond, you are lending your money to the government. If you purchase a bond that is for a company, then that's called a corporate bond, and you are lending your funds to that company. When you purchase that bond, most of the time, they pay you back at a particular interest rate. So if you purchase $100 in bonds and it pays 5% for 5 years, basically that means that every year you'd get $5 back for the $100 that you've lent that company. And at the end of those 5 years, then you'll get your $100 back as well. So when you're investing in a bond, it's normally for that company or for that government to do a specific project that they think will make money. So then they are willing to pay that interest because they can cover the interest that they're paying to you. These tend to be seen as safer investment options as opposed to stocks. Especially with a bond, you can check the value of the company, check how strong the company is, and if they are able to pay you. While with stocks, sometimes sentiment, like with GameStop, just how people are feeling may determine the share price. While with a bond, what they're supposed to pay you is what they'll pay you as long as they can. I know a lot of people got burnt recently with government bonds because the government defaulted. And again, investing is a risk. There is a risk there, but again, we see what the risk is. We have to determine if we think this organization or this government is able to pay, or what they want the bond funds to do, if it's something that's feasible that will actually make money. At the the most risk averse investment is what we call money market, and that is investing in things that are 1 year or less to maturity. So that may be purchasing a deposit from a bank, or a term deposit for 1 year or for 6 months, and those normally pay very little interest, and they're based on that company's balance sheet. So those guys have a lot of money, those banks have a lot of money, and they're borrowing that money from you, really, to lend it to someone else. So your savings accounts at banks are forms of deposits that the bank is taking your money and lending it to someone to build a house. So the lower those interest rates are to you, hopefully the lower the interest rates are for the house as well. But we can discuss that further in a later video. I hope that you learned. If there's anything that you want clarity on, be sure to ask below in the comments. See you next time.